Welcome to Investors Insights. Our topic today is 7% gauge. We chose that topic because this is a big week of earnings, especially with technology companies, and we'll be watching that closely. But there are also indicators we want to bring you up to date, and we want to continue throughout the week on information through our social media in terms of Facebook, Twitter, LinkedIn, our podcast, YouTube, as we communicate as well as our discussions for this week about these indicators you need to be watching. So often we get calls from people where they've heard different topics on the news that are emotional. And in reality, we want to back it up with facts and give you details that you need to be aware of. I am joined today by my distinguished colleagues. Gentlemen, I paid you a compliment. Ty Miller and Bobby Norman. And guys, thoroughly enjoyed our meeting this morning. I'm always impressed with the research that you bring to our meetings, and I thank you for that. So 7% gauge. Bobby, in relation to earnings, in relation to market history, what does that mean to our viewers?
Yeah, so this will be one of the busiest weeks for first quarter earnings season. So we want to address a lot of the concerns around expectations for earnings growth to be negative in Q1 and also for the second quarter in a row. And if you watch our blog, you know, a lot of times we follow corporate earnings very closely, as earnings are an important longer-term driver of stock prices. However, in the short term, the S&P 500 has actually held up okay after two consecutive quarters of negative profit declines. And so looking at this chart here, going back to 1948, the S&P 500 average price performance following a second straight quarter of year-over-year earnings decline, like we'll probably have, the market is actually up 3, 6, and 12 months after. So let's focus on this middle column here in the chart that shows that market performance 6 months after two consecutive quarters of profit declines. And actually, history shows the market is up on average 5.9% and up 7.4% in periods if you take out economic recession. So history says investors shouldn't get caught up in the doom and gloom concerns around earnings season, as long as they have a balanced and diversified allocation, which we've been talking about. An interesting fact about the market, as you can see in this chart, when the S&P 500 has gained more than 7% in the first quarter, like it did this year, the S&P 500 has never had a negative full-year return with an average gain of 23%. So, as always, no guarantees, but history in the market shows that investors should remain calm when it comes to mixed earnings results and other concerning headlines.
Yeah, I thought those were excellent charts that you provided today. And then, of course, in terms of our philosophy, you know, history doesn't repeat itself, but it sure can rhyme. I think that those are two great charts that just show that there's a lot more going on here that could take place compared to what some of the media is highlighting in the news right now. And speaking of media and highlighting, a topic that's going to become intense over the next few weeks and probably continue on into the summer is the debt ceiling. And Ty, you did some thorough analysis this morning talking about that. So how does that relate and cause emotion in the markets in comparison to what Bobby just talked about?
Well, politics always cause, some emotion in the markets. That's certain. As Bobby mentioned, it's a big week for earnings. It's also a big week for the House Republicans here. They're going to try to pass a bill to vote on for $4 trillion of spending cuts while raising the debt ceiling. Now, this bill, if it passes the House, is unlikely to get through and be fully enacted. There will be some changes to that, but it's an important first step in these discussions. If they're unable to pass that, kind of the leverage will shift to the Senate, and they'll have their kind of chance to get through something where I'm sure there will be changes in the long run. However, it's important to get that first step in, as we got some tax revenue numbers, and it's just looking like with them being a little lower this year, this debt ceiling X date might move up into June. And so with that being the case, it's going to be important to get this first step through. I think the House is really trying to push for this to get through this week as they see this June date, becoming a possibility. Now we're not in any, I'm not saying we're not in any, concern for default or anything like that, but this would be an important first step, to make that even more or less likely, which would be, a good sign.
Yeah, and this isn't the first one I've been through in my career, and it's always gets emotional, and the media really picks up on it. And I've even been in situations where they shut down the government for so many days just as they continue to make it an issue. So there will be emotion out there, folks, but we're going to continue watching the facts. As Bobby said, in terms of the markets, we got to look at earnings. We've got to look at interest rates. We've got to look at these other topics. These political debates will come into play and we'll navigate through them. But we like to keep you informed as to what's actually going on. So with that, we hope you have a great week. We cannot believe we're getting ready to finish up the month of April, the first month of the second quarter. We're going to continue keeping you updated as these topics continue to evolve. And if you have questions, need to talk one-on-one, have a virtual meeting or in-person meeting, don't hesitate to let us know. We're going to be reaching out to you, but we like to have this dialogue. We hope you have a great week. We hope this has been worth your time. And for those of you who continue to forward this to colleagues and neighbors and family and friends, we can't thank you enough, because it just shows that we're providing great information to you, and we appreciate you sharing it with others. Have a great week. Talk soon.